macro currency signals.
I need you to slow down and listen carefully because February is not just another page on the calendar. It is not a routine month in a routine year. What we are witnessing right now is a pressure buildup inside the global financial system that small silver holders cannot afford to ignore. This is not noise. This is not hype. This is structural tension rising beneath the surface of markets that appear calm only because most people are not looking deep enough. The global monetary system is stretched. Debt levels are extreme. Liquidity conditions are tightening in some areas while being forcefully injected in others. Currency purchasing power continues to erode, not in dramatic headlines, but in slow, silent compression of real value. Prices rise gradually, then suddenly. Confidence fades gradually, then all at once. History has shown that financial instability does not announce itself politely. It develops quietly and then accelerates faster than conventional wisdom can react. Silver is beginning to reflect that tension, not loudly, not explosively, but subtly. Before we go any further, if this breakdown is resonating with you, make sure you're subscribed and your notifications are turned on. In moments like this, timing matters. Being early isn't a bonus, it's the advantage. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation isn't confined to one country. It's global. And seeing how far this message reaches says more than any headline ever will. Now, let's get back to what just happened. Premiums on physical metal are diverging from paper pricing in ways that signal stress beneath the surface. Delivery timelines are stretching in certain channels. Inventory flows are tightening. These are not coincidences. These are early warning signs. When physical markets begin to separate from paper representations, it tells you something fundamental is shifting. Small holders who fail to recognize this divergence may find themselves reacting too late. Understand this clearly. Silver is not just a commodity. It is monetary history compressed into metal. It is industrial necessity embedded in technology. It is scarcity in a world drowning in synthetic liquidity. When currencies expand without restraint and debt accumulates without structural reform, tangible assets do not behave the same way as paper claims. They respond differently because they exist outside the promises of institutions. Silver does not rely on solvency. It does not depend on confidence in fiscal discipline. It simply exists, finite, measurable, and historically trusted during periods of instability. And we are entering one of those periods. Inflation is no longer theoretical. It is embedded. Even where official metrics suggest moderation, lived experience tells a different story. Energy, housing, food, insurance, logistics, these are not isolated sectors. They are the bloodstream of the economy. When these rise persistently, it indicates currency pressure. When currency weakens, hard assets eventually respond. But here is what small holders often misunderstand. Silver does not move in a straight line. It compresses. It consolidates. It tests conviction. It shakes out impatience. Then it reprices. The danger in February is not collapse. The danger is complacency. Markets can appear stable right before volatility expands. Bond yields can stabilize before breaking higher. Currency indices can drift before suddenly adjusting. And when these adjustments occur, silver does not wait for retail confirmation. It moves with institutional capital, macro funds, industrial procurement shifts, and strategic accumulation flows. By the time headlines catch up, repricing has already begun. Small holders must ask themselves a serious question. Are you positioned or are you observing? Because observation without preparation becomes regret. Look at the structure forming beneath global markets. Sovereign debt burdens are no longer marginal. They are central. Refinancing cycles are colliding with higher interest costs. Governments cannot reduce spending meaningfully without economic contraction. They cannot raise rates aggressively without destabilizing balance sheets. They cannot print aggressively without risking currency credibility. This is not a stable equilibrium. This is a narrowing corridor, and silver thrives in narrowing corridors. Why? Because silver sits at the intersection of monetary uncertainty and industrial indispensability. It is demanded by emerging energy infrastructure. It is embedded in electronics. It is required in medical applications. It is increasingly critical in next-generation technologies. Supply growth does not expand easily because mining is capital-intensive, politically sensitive, and geographically concentrated. So while paper markets fluctuate, the physical foundation tightens slowly. This is how structural repricing begins. Small holders must also understand the psychological cycle. Retail investors often respond to silver emotionally. They buy when price surges. They hesitate when it consolidates. They panic when volatility spikes. Larger participants understand this behavior and position ahead of it. The current phase feels quiet. That is precisely why it matters. February represents a compression zone. Monetary policy expectations are shifting. Currency strength narratives are being tested. Liquidity injections in some regions contradict tightening elsewhere. This fragmentation signals instability beneath coordinated messaging. When coordination weakens, volatility strengthens. Silver is sensitive to that shift. Another factor rarely discussed openly is trust. Trust in fiscal discipline. Trust in currency management. Trust in debt sustainability. Trust in cross-border trade stability. Trust in supply chains. When trust declines, tangible assets gain relevance. Not because they are perfect, but because they are independent of promises. Small holders cannot control macro policy. They cannot influence debt issuance. They cannot redirect global liquidity flows, but they can control positioning. And positioning ahead of volatility is different from chasing it. Right now, physical silver premiums relative to paper benchmarks offer information. Industrial procurement flows offer information. Currency movement relative to commodity baskets offers information. Real yield fluctuations offer information. The question is whether small holders are interpreting those signals or waiting for validation. Waiting is expensive. Markets do not reward delayed clarity, they reward anticipation. Consider historical patterns. Financial dislocations rarely begin with visible panic. They begin with subtle distortions, yield curve shifts, liquidity stress in secondary markets, divergence between spot and physical pricing, capital flight from certain asset classes into hard collateral, then acceleration, and acceleration punishes hesitation. February is a hinge point because multiple macro variables are aligning simultaneously. Elevated sovereign debt rollover cycles, fragile supply logistics, industrial silver demand resilience, currency credibility concerns, and investor sentiment compression. This is not random. It is convergence. Convergence produces movement. Small holders must understand the difference between volatility and opportunity. Volatility is price movement. Opportunity is preparedness before movement. If you are holding physical silver, evaluate accessibility, evaluate liquidity channels, evaluate storage security, evaluate acquisition timing relative to premium compression windows. If you are holding paper instruments, understand counterparty exposure and redemption structures. This is not fear-based thinking. This is strategic thinking. The greatest mistake small holders make is assuming that silver will eventually perform without needing active awareness. Long-term conviction is powerful, but timing within cycles determines whether conviction produces advantage or stagnation, and cycles are tightening. The macro environment is not normalizing. It is straining. Global trade tensions are reemerging. Supply chains are reorganizing. Commodity corridors are shifting. Currency blocks are experimenting with alternatives to dominant settlement structures. These transitions are not smooth. They create friction. Friction creates pricing distortion. Silver reacts to distortion because it is both monetary and industrial, because it is both scarce and essential, because it is both ancient and technologically indispensable. Small holders who recognize this duality understand why February cannot be ignored. This is not about predicting exact price targets. It is about recognizing structural inflection. The window to prepare before repricing narrows quickly once momentum begins. Premium spikes do not give polite warning. Inventory drains do not reverse instantly. Currency confidence does not deteriorate gradually once thresholds break. The shift from calm to volatility can occur within weeks, and weeks matter. This is why urgency is not emotional. It is analytical. The data supports it. The macro alignment supports it. The supply dynamics support it. The psychological compression supports it. The only question is whether small holders will act with discipline or wait for confirmation that arrives too late. Silver does not wait. History does not pause. Markets do not extend courtesy to hesitation. February is not dramatic. It is pivotal. And pivotal moments reward the prepared. Now we move deeper because understanding the pressure is only the first layer. The second layer is trajectory. Where is this heading, and what does it mean specifically for small silver holders as the year unfolds? The environment we are entering is not cyclical in the traditional sense. It is structural. Cycles recover, structures transform, and when structural transformation begins, assets tied to the monetary foundation of the system begin to behave differently. Silver is one of those assets. The global financial architecture has been operating on expanding leverage for decades. Debt layered upon debt. Stimulus layered upon stimulus. Liquidity layered upon liquidity. For a long time, falling interest rates masked the fragility of that system. Cheap money concealed imbalances. But when interest rate regimes shift, even modestly, the mathematics change. Refinancing costs rise, sovereign budgets tighten, corporate margins compress, consumer credit strains, and when strain becomes visible, capital begins searching for safety. not theoretical safety, tangible safety. Silver historically responds not when everything collapses, but when confidence begins to fracture. That fracture may appear small at first, a currency weakening faster than expected, a bond auction that struggles, a liquidity injection that contradicts tightening rhetoric. These are the cracks, and silver does not wait for the wall to fall. It reacts to the cracks. February represents a phase where those cracks are becoming measurable. Look at global liquidity conditions. In some regions, central authorities are attempting to drain excess liquidity to combat inflation. In others, liquidity is being quietly reintroduced to stabilize debt markets. This contradiction creates instability beneath the surface. Capital flows become unpredictable. Exchange rates swing more aggressively. Commodity markets begin reflecting stress before equity indices do. Silver sits directly inside that flow of capital adjustment. Now consider industrial demand again, but this time in forward motion. Renewable infrastructure expansion is not slowing. Technological manufacturing is not contracting structurally. Electrification trends are accelerating globally. Silver is a core input in these systems. Even marginal increases in industrial demand can tighten physical supply because annual production growth is limited. Mining output cannot expand overnight. Exploration cycles take years. Permitting takes years. Infrastructure takes years. But investment demand can shift in weeks. That imbalance between slow supply growth and potentially rapid investment demand creates asymmetry. And asymmetry is where opportunity lives, but also where risk accelerates for the unprepared. Small holders must recognize that the next major move in silver will likely not feel gradual. It will feel abrupt. That is how repricing works in compressed markets. Long consolidation phases are followed by decisive expansion phases. The longer the compression, the more powerful the release. We are in compression. The danger is assuming compression equals stagnation. It does not. It equals stored energy. Another dimension that must be addressed is currency competition. Global settlement systems are evolving, trade agreements are shifting, bilateral currency arrangements are increasing. Reserve diversification conversations are becoming more frequent in certain corridors of the global economy. Whether these transitions succeed or not is less important than the fact that they are happening. When dominant currency structures are questioned, even slightly, precious metals absorb that uncertainty. Silver benefits from this dynamic not only because it is a precious metal, but because it is accessible. Smaller investors can accumulate it more easily than other hard assets. That accessibility becomes powerful during phases of rising distrust and fiat stability. Trust erosion is gradual until it accelerates. Once acceleration begins, capital rotates quickly. Small holders must think beyond price charts. They must think in terms of systemic pressure thresholds. At what point does inflation reaccelerate? At what point do bond markets demand higher compensation for risk? At what point do currency markets reflect fiscal imbalance more aggressively? These thresholds are not theoretical. They are mathematical, and they are getting closer. Now let's address volatility directly. Silver is volatile. It always has been. But volatility in an environment of structural macro stress behaves differently than volatility in a stable expansion cycle. In stable cycles, volatility is often speculative. In stressed cycles, volatility is repricing. There is a difference. Speculative volatility retraces quickly. Structural repricing volatility establishes new floors. Small holders must prepare mentally for this distinction. If silver begins moving aggressively, pullbacks will occur, but the broader trajectory, if structural forces continue aligning, will not resemble prior muted cycles. That is why psychological discipline becomes critical. Fear causes selling too early. Euphoria causes buying too late. Preparation prevents both. Another crucial element is physical availability. When investment demand increases rapidly, retail supply channels tighten first. Premiums expand before spot prices fully reflect scarcity. This divergence can frustrate small holders who wait for perfect timing. They may see a spot dip, but find physical premiums unchanged or higher. This is not manipulation, it is supply mechanics. Understanding this in advance prevents emotional reaction. The key question for every small silver holder right now is simple. Are you positioned before acceleration, or are you planning to position during acceleration? Because those are very different experiences. Positioning before acceleration feels uncomfortable. It feels early. It feels uncertain. Positioning during acceleration feels urgent. It feels obvious. It feels crowded. Crowded trades are expensive trades. February sits at the edge of that psychological transition. The broader public is not fully engaged. Headlines are not screaming scarcity. Retail panic is not visible. That is precisely what makes this phase important. Calm before expansion is where strategic accumulation happens, but calm does not last indefinitely. Let's project forward realistically. If debt burdens remain elevated, if inflation proves sticky, if currency volatility increases, and if industrial silver demand remains strong, which all current indicators suggest, then 2026 could reflect materially higher silver pricing environments than those normalized in recent years. Not because of speculation, because of arithmetic. Finite supply plus expanding demand plus monetary instability equals upward pressure over time. The only uncertainty is timing, and timing windows are narrowing. Small holders who assume they can wait for clear confirmation misunderstand how markets move. Confirmation often appears after the majority of the move has occurred. Early positioning feels uncomfortable precisely because it precedes consensus. Consensus is late, preparedness is early. Another risk to consider is policy response. If financial markets experience stress, authorities may respond with renewed liquidity measures. Liquidity injections weaken currency purchasing power over time. Even if temporarily stabilizing markets, they increase long-term pressure on hard assets. Silver responds to that environment. But again, it responds rapidly once confidence shifts. Small holders must also avoid a common error, over-leveraging exposure. Structural opportunity does not justify reckless positioning. Discipline matters. Allocation should reflect risk tolerance and liquidity needs. Holding silver as a hedge is different from speculating aggressively. The former preserves stability, the latter amplifies stress. This moment requires strategic calm, not emotional intensity. Preparation, allocation review, liquidity planning, secure storage, market awareness, psychological discipline. Those are the tools. Now step back and observe the broader picture one more time. Global debt elevated, monetary tools stretched, inflation persistent, industrial demand resilient, supply constrained, currency competition increasing, market sentiment compressed. This is not random alignment, this is convergence. Convergence precedes movement. Small silver holders who recognize convergence before expansion place themselves in a position of strength. Those who dismiss it as background noise risk scrambling during repricing. And scrambling is expensive. February is not dramatic because the headlines are loud. It is pivotal because the silence is misleading. Structural tension does not announce itself with sirens. It builds quietly. Silver is signaling, subtle but clear. The question is not whether silver will move eventually. The question is whether you will be positioned correctly when it does. Because once acceleration begins, time compresses. Decisions become reactive, premiums expand, liquidity tightens, confidence shifts, and those who hesitated will say they didn't expect it so soon. But the signals were always there. They are here now. So to every small silver holder listening right now, February demands seriousness. Not panic, not hype. Serious evaluation, serious positioning, serious awareness of the macro forces building beneath the surface of the financial system. Silver stands at the intersection of monetary instability, industrial necessity, and supply constraint. That intersection is tightening. The window to act calmly before volatility expands is open, but it will not remain open indefinitely. History consistently rewards those who prepare before consensus forms and punishes those who wait for certainty. This is your moment to reassess, to secure, and to position with discipline. The storm does not send invitations. It tests readiness. Take this update seriously. Stay alert, stay strategic, and make sure that when silver moves, and it will move, you are not reacting to it. You are already prepared for it.